Good morning. It's Jeffrey Christian of CPM Group. It's 10:40 in the morning here in New York on Tuesday, the 16th of April. I want to talk about the gold market and to some extent the silver market, the factors behind the rise and fall in precious metals prices last week. We've seen these markets moving higher for more than a month now. Really, since the beginning of March, they've been moving much sharply higher. Last Friday, we had a very steep increase in gold and silver prices, as well as copper, platinum, and palladium. And then the prices came off on Friday afternoon. But there's a lot of hooey going around all of these markets, and I'm afraid that we're going to have to talk about it. And hopefully I'll talk about what the future holds, too. Preface. We've spoken in the recent weeks about past examples of how metal prices, gold specifically in the examples we used in those videos, often fall sharply after they've risen sharply. This is true, and it doesn't represent a nefarious smackdown. It is widespread profit-taking from intelligent investors around the world. That was the case in January of 1980, in March of 2008, in September of 2011, and at other times. And it still is true. We're seeing a lot of garbage information circulating the gold, silver, platinum group metals markets right now. They're getting hot. Commodities, investors are pouring into it. Some investors have never been involved in commodities. Others are very opportunistic, and they're coming into it new after being away from it for 12 years or so. And there's bad information that's circulating. We've seen more than $1 billion worth of money go into commodity index funds over the last month and a half, chasing these prices higher. And in that environment, bad information comes. I've said it in the past. I'll say it again. One of the things I like about the precious metals markets and commodity markets in general is their intellectual asymmetry. There is very little good information around. It is very unevenly spread across the market. There is a tremendous amount of misinformation and what you would call malinformation, consciously misleading people about what's going on. These are relatively secretive, illiquid markets. They are underregulated compared to stocks and bond markets. And they are vulnerable to bad information. We're seeing bad information in gold, silver, platinum markets right now. CPM Group likes to use these videos to talk about what's really going on in the market and what's real research. Unfortunately, right now, I think we're being distracted and have to be distracted by some of this bad data simply because it's misleading investors. So yes, gold and silver prices rose sharply. They rose particularly sharply last Friday, and then they came down. Why did prices fall sharply? There are all kinds of people saying all kinds of stuff. Oh, the prices rose on one big investor, and having finished his investment, he walked away. It's one large institution. It's a whale. It's blah, blah, blah. It's a bunch of nonsense. Prices rose on broad-based buying around the world by investors who looked at the world, the state of the world, and said, I think I want to have more precious metals. And prices fell sharply on Friday on profit-taking. And there were a lot of shorter-term investors who came into the market just last week or over the last several weeks who took profits going into a weekend. The majority of market participants in gold and silver are rational, and they don't believe all the hooey that you hear. So when they see prices spike higher on a day or several weeks of sharply higher prices, they take profits. And they often take profits going into a weekend just to lock it up. So when gold rose 20% over the course of a couple weeks, and silver rose 33% or 32% over the course of a couple weeks, the vast majority of short-term investors said, this is a good time to lock in profits, either by selling my metal or selling my futures or buying puts. So you saw a big surge in trading volume, not just in precious metals, but in copper options as well, and in a number of other commodities. And it was many buyers and sellers around the world. It wasn't a single entity. And no one should believe that. It's just not true. And as I said, there was a lot of unfounded rumor mongering. There's no slam down. Only people with no real knowledge of how the gold and silver markets work, how financial markets work, would even talk about such nonsensical stuff. Even more incredulous is the idea that the U.S. Treasury would be behind such a slam down. The Treasury owns more gold than anybody else on Earth, 261 million ounces, worth approximately $620 billion at prices around current levels. Even so, the U.S. Treasury understands that gold has little relative monetary utility to it beyond being a monetary reserve. People who don't understand central bank monetary reserve policies say, why is it that the U.S. Treasury holds so much gold while all the other central banks hold so much dollars? 60% of foreign exchange reserves held by central banks are held in U.S. dollars. But the U.S. Treasury holds no dollars. Well, the U.S. Treasury cannot hold U.S. dollars as foreign exchange because it's not foreign exchange. It's the U.S. dollar. Furthermore, there are other regulations that apply to the U.S. Treasury, not earning interest and other factors there. Other central banks hold the dollars because it's the de facto reserve currency right now. The Treasury has more to gain in rising silver gold prices than anybody else on Earth. It has no reason to wish for lower gold prices. And it understands that gold has limited utility related to fiscal imbalances. That $620 billion worth of gold represents 5 months worth of the U.S. government's current fiscal deficit. It's not going to solve the fiscal deficit problem. It's less than 2% of the $34 trillion in U.S. debt. So that gold's there, but it doesn't really necessarily help it. And there's absolutely no rational reason for the U.S. Treasury, or bullion banks for that matter, to slam down the price. You might find traders on desks spoofing the market, but you're not going to find a grand slam down in prices. And the U.S. Treasury, of all people, has the least interest in seeing that. Now, another topic I wanted to talk about was why there was no spike in oil prices after the 13th of April Iran barrage of missiles and drones into Israel. Main reason is that no oil exporter wants to raise oil prices at this time. The global economy growth is weakening. We are seeing 2 quarters of virtually no growth, if not outright contraction, in Germany and the UK already. Industrial production figures came out from the Fed today for the most recent month in the United States at 0 growth overall, and contractions in consumer goods and in housing and other factors. Fortunately, there was a strong growth in business equipment orders and production, which is good because that's a leading indicator of other economic activities. But you've got an economy globally that is slouching toward a recession or much lower growth. And oil exporters don't want to see that because they make money selling oil to an industry that is in a global economy that is, well, let's say, well-oiled. They would see lower oil demand and probably lower oil prices in a recession, and they don't want that. Additionally, many major oil companies are not friends of Iran. They would love to see Israel defang it. It's just not going to happen, probably. Iran, for its part, sees itself as having four major enemies. Its most important enemy in its mind, if you read foreign policy information coming out of Iran, not from Western sources, is Saudi Arabia. Pakistan is its second largest perceived enemy. The United States is the third, partly because we've supported Saudi Arabia for 80 years. And Israel is the fourth, and is useful to Iran only as a propaganda tool. Let's distract all of the people in the Muslim world from what governments, Muslim, Islamic governments have done to them by having an external enemy in the entity of Israel and the United States. So it's highly unlikely that the major entities of the oil exporting world want to see higher prices and would push prices higher. In the late 1980s, Iran and Iraq were at war. And at one point, the Iraqi Air Force started shooting missiles at Kuwaiti oil tankers and other oil tankers in the Persian Gulf. The Kuwaitis asked the United States to provide naval protection for their tankers. There was a long debate in Congress about whether we should do this, and ultimately they reflagged Kuwaiti tankers as U.S. registered ships, and the U.S., I believe it was the 7th Fleet, sailed into the Persian Gulf and is still there and is still protecting the oil ways there. When the 7th Fleet sailed into the Persian Gulf, people in Europe and the United States expected the gold price to rise sharply because this represented the U.S. Navy getting in harm's way vis-a-vis the war between Iran and Iraq. The oil price fell sharply. We called our clients in Kuwait and the UAE and Saudi Arabia, and we said, can you explain this to us? And they said, our problem is solved. Our risks have just plunged. It's now the U.S. Navy's problem. It's the U.S. Navy's risk. The U.S. Navy's still there guarding those waterways. And it's going to be interesting to see what they do because Iran is showing signs of wanting to disrupt the flow of tankers and other ships through the Persian Gulf and the Straits of Hormuz. But for now, they haven't succeeded. They've got the U.S. Navy, which has more firepower than all of the armies combined in the world through history, in between it and Saudi Arabia. And it's going to be interesting, but it's probably improbable or unlikely that you'll see oil prices spike higher, except on a very brief basis because of those problems. Oil prices could spike higher for other reasons, but not that. Now, I wanted to end with a couple questions. These are CPM Group's intermediate-term gold recommendations since 1980. In 1980 to 2000, back and forth, about 68% of the time, we said, don't buy gold, don't be long gold from a 2 to 3 year price expectation perspective. You should be shorting gold. In November of 2000, we gave a speech when we launched our gold yearbook, which was called the Gold Survey back then. And we said that we thought that for the next several decades, the economic, financial, and political environment would be more hostile than it was in 1979 when gold went from $190 to $850. And we thought that gold prices would spike way past $850 and stay higher for longer. That $850 would look cheap in hindsight over the next several decades. We kept that buy recommendation in place from November of 2000 into January 2nd of 2012. We actually started telling our clients to sell their gold in September and October of 2011, but we issued a formal printed, published sell recommendation in a report, Precious Metals Advisory, first one of 2012, title, A Time to Sell. We issued a buy recommendation around 2013, 2014. A little bit premature. The price moved sideways for 5 years, but now it's been rising. And that buy recommendation is still in place. And these are all published. So any troll who wants to say that I'm a bear is just a liar. And they're one of those people who do something that I just don't understand, but it's very common. They speak about things that they clearly don't know anything about. Similarly with silver, we issued a buy recommendation for silver in around 2001. We took it off in April of 2011, and we put it back on around 2019. And we've had a buy recommendation on silver for 2019. And we've been talking about gold and silver. Gold prices were rising to new record highs in 2024, 2025 for several years now. And we've been talking about silver rising to average well over $30 at some point in 2024, 25, 26 for several years now. And by the way, the record annual average price, because that's what we project, the record annual average price was around $35 per ounce in 2011, 2012. So we're talking about silver prices on an annual average basis approaching their past record high. We're not talking about $100 silver. I know there are some people doing that, but it's not us. We will be coming out with our silver yearbook on May 14th. It will have definitive statistics on supply, demand, how much silver is actually being used in solar panels as per told to us by the silver panel manufacturers, right? Inventories, investment demand, the supply-demand balance. We'll probably do some reports for our clients and maybe a video between now and May 14th on the title of the Silver Shortage Chimera, because there's a lot of garbage going around about silver being in a deficit and running out of above-ground inventories, and it's just not accurate. And we may do a similar one on platinum, because platinum's not in a deficit. People keep asking us, how is it that platinum prices can be so low if the market's in a persistent deficit? And the answer is, I don't know, because the market's not in a deficit. The market has been in a surplus for most of the last half century, and it continues to be in a surplus. And that surplus explains the lower platinum prices. If you're looking at free data that you get from some marketing glee in silver or gold or platinum, and they're telling you there's a deficit and a shortage and the price should be much higher, you're looking at marketing reports. As the head of one of the world's largest precious metals refiners said to us years ago, CPM Group sells research, they sell advertising. If you want to base your investment decisions on advertising, that's your prerogative. It's a free country still. Take care. We'll talk to you on Friday. In the meantime, take care of yourself, take care of people around you, see what you can do for the world, even if it's just picking up garbage on your way home. That's better than nothing. Take care.